How much are interest rates going to rise? How much is this inflationary period going to cause property prices to go down? And what is the health of the Australian economy? This is what we'll be covering on this video. If you're interested, stick around. I just did a video 2 days ago on part 1. This video is part 2. I'll link that video right now. So if you haven't watched it, go back and watch that one first and then come to this because it's in sequence. But let's get into it. Now, I went through about 7 charts in the previous video. In this video, I'll go through another, let's say 7, 8 charts. And once again, the idea is to give you an understanding of what's going on with the Australian economy from different angles of vision. Just like a diamond, you know, there's not just one face of a diamond, there's 4 or actually many more than 4. That's what you need to understand of the Australian economy to actually make money in property, to actually make money full stop. You need to become more knowledgeable, more intelligent. So go back and watch that first one. If you have watched it, let's carry on. So, you know, we left off, and where I want to kick off from the unemployment story, from the fact that savings rates are so high, is that incomes are also growing in Australia. All right, so wages and salaries, and by the way, it's all CBA data. Wages and salaries, they've kind of been up and down, but ever since that kind of low in March, April 2020 when COVID first started, wages and salaries have been, coming right back up. So they're not as high as they used to be, in the previous decade back here, but they're still very high. So it's good momentum. Wages and government benefits paid. Now, obviously, there's been a lot of government benefits in this period between February 2020 and February 2021. There's yellow indicates the quantum of government benefits paid, and that's understandable. There was JobKeeper, JobSeeker, something to hold the economy up while the world was kind of in lockdown. But you can see what's really interesting now is that in more recent times there's not really much government benefits paid, and that's because I just demonstrated before the labor market's so tight. Everyone has a job who wants a job. Utilization, underemployment has come down. Things are going well. People are saving money. Therefore, there's less government dole and things like that to be paid. And salary and wages paid. All right, 28-day rolling average. You can see ever since that kind of the woes of mid or start 2020 when COVID started, things have just got better and better and better. So not only are savings rates high to insulate us from higher interest rates and foreclosures and defaults, not only is unemployment down, not only are people spending money and saving it, but actually incomes are rising. Okay, so that's 4 sides of the economy so far. Let's carry on. Business investment to lift solidly in 2022. Okay, so we talked about consumers. Now let's switch over to the commerce, or to the B2B, or to the business B2C side of the equation. So capital expenditure. CapEx is not expenses. CapEx is investment to grow your business. Okay, it's from an accounting perspective, it's different from your profit and loss statement necessarily on an ongoing basis. It's really where you want to say, okay, I'm so confident, I want to grow my business because I'm going to make more money. The economy is growing. Okay, and you can see that the implied intentions are on the way up. Okay, this graph is going back 20 years. You can see this was the last time things were super awesome, and around 2011 is when interest rates went up a little bit. You can see why, because investment was on the way up, both for mining and non-mining, and now we're just starting that cycle again. Okay, this means that, of course, inflation is there, but the Australian economy is strong. Okay, just because inflation is high doesn't mean the economy isn't strong. I think you need to understand this. Businesses want to spend more money. Businesses want to grow. Business credit is going up. So whereas business credit really died down because confidence was low in the last sort of year or two, obviously because of COVID, and has been a bit helter-skelter, really for the last 5 years. Now business is really, really strong because the underlying demand of the consumer is also very strong in Australia. And private non-mining business investment, you can see it's been a bit iffy. You can see it back in this red as well. It's been a bit flat. It is a bit flat, trending a little bit down. So let's see how that continues to fit. Now that's an open question mark. plenty of public investment and infrastructure in the pipeline. Okay, so we talked about the consumer side of the story, how much savings they have in the bank, which is a tick, how much incomes are growing, which is a tick, how employment is so high, which is a tick. We talked about business investment, which is a tick, and let's kind of monitor it. Now let's talk about how much governments are spending, which is really a big sort of contributor or injection to infrastructure in the pipeline. So I won't go into it in too much detail. We dive deeper into this in the Property Investment Accelerator to understand on an LGA by LGA basis what's going on, to form our opinion and data-based view on where to invest and not invest. But suffice to say that infrastructure forecast, this is 2022 down here. Okay, so we're not here, don't worry, we're at 2022. Over the last 5 years, infrastructure has been steadily increasing overall, not everywhere. Some areas have been going down. The color coding is all state by state. But in the next, from 2022 to about 2025, when there's this big peak occurring, when there's a lot of money being spent by the government. Remember, when the money gets spent by the government, it goes into the coffers of you and me, consumers and business owners, because that's who the government pays to get stuff done. All right, so state by state, I won't go through it in detail, but you can see, for example, here, Victoria, there's a lot of money, a lot of investment going on in Victoria. I would almost hazard a guess to say that's probably the area where there's the most infrastructure spending going on, especially in regional Australia. So from a government health, confidence, spending, infrastructure improvements perspective, the Australian economy is very strong. Now let's come to housing. We know how strong or how important the construction sector is to the Australian economy. Residential construction is booming, but there are capacity constraints. Okay, so building approvals for detached houses. Remember, supply is the enemy of growth. When supply goes up, prices come down. This is just an overall statement, a general statement. There's always markets within markets. But detached houses, because of all the government grants, first homeowner subsidies, all that kind of thing, there's a lot of new houses being approved to build, right? That's a fact. And it's mostly detached houses. High density stuff has always been high, but detached houses has gone up. So, should we invest in property or not? If there's all this new housing going to come online and really depress house prices, what's going on? All right. But there are capacity constraints. Okay, there are capacity constraints. So this is CBA lending. Lending has gone through the roof, both to developers and residential homeowners. So people want to take loans and they want to buy property or develop property, and new dwelling purchases has gone up as well. However, what you're not seeing in these charts is that most of these loans for new houses haven't actually eventuated because building costs have gone up, building materials haven't been easy to source. So a lot of this detached housing spike, a lot of this, because you can see this is CPI, new dwelling purchase CPI, the prices have gone up so much. They just haven't gone out of the ground. The houses haven't been built because the materials haven't been there. So that's depressing the supply story and providing a floor under house prices, which is very interesting in my mind. Inflation data has been very strong, very, very, very strong, as we know. Let's dive deeper into that beyond just the surface level media commentary. So consumer prices, underlying average of the inflation has gone up, and the headline inflation has gone up as well. Obviously, rents are a big component, or I should say housing, is a big component of inflation, and that's gone up in value. So this headline inflation has gone up, underlying inflation has gone up beyond that 2 to 3% range where the RBA wants it. In fact, it's been within the 2 to 3% range, broadly speaking, for more than a decade, back to September 2006. That's when it kind of came down into the range, and it's been there or thereabouts for a long time. Okay, but also the kind of key takeaway I want to mention is, it's high at the moment, but it's been this high before. It's been this high just before or 2006, and then we had the GFC, which was caused by the US subprime mortgage crisis, and the property prices in Australia came down about 5%. Okay, so just kind of try to see things in context. Before that, we've had headline inflation in year 2000 up to 6%, before that even higher. So this is not a new thing. It's not that you have to panic. It's just part of the cycle. Inflation pressures Okay, inflation pressures. This is just kind of annualized data. It's all trending upwards. And in terms of the mix, what's causing inflation? Is it goods or is it services? You can see that services really tanked, this maroon line, because of various reasons like the lockdowns in the last 1 or 2 years. And people can't go out to get a haircut, therefore services are down, but goods have continued to go up. It's really goods that's causing this inflation, not services. And goods come from overseas, services are predominantly provided locally. So we've imported this inflation. It's because of everyone knows, supply chain bottlenecks and other things like that to a large extent. And the RBA, I want to mention, the RBA doesn't just care about inflation, it also cares about wages or labor costs. So wage measures have definitely gone down. So wage measures, they've kind of, let's see, all the way from 1997 to 2021, end of last year, kind of generally been trending down. Wages haven't been growing in this country for the last 10, 15 years. That's a fact. I mean, not real wages anyway. And finally, they've kind of started to up. But they're still not at very high levels. So the point of this slide is really to say that yes, inflation needs to be curbed, but not always at the expense of wage growth. The RBA doesn't just care about inflation, also wants wages to grow. That's also part of its remit, as well as economic health more broadly. So it's not just going to increase interest rates willy-nilly all the way to the moon whilst people's wages start dropping. Okay, if you're an economist, I'm not saying I'm a practicing economist, but I did do economics at university, you start to understand these sort of nuances. And once again, this wages haven't really been growing that much. This is all positive data. It's all growth data, but wages, last time they grew at more than 4% was, before 2010. And then in the last decade, 2010 to 2020, it's really been very depressing and productivity has been very low. So what the RBA doesn't want is to increase interest rates too soon, too quickly, and then have this line go further and further down. That wouldn't be a good thing for purchasing power for the average Australian. And wages at the start of an interest rate hiking cycle, this thing right here. So generally interest rates start going up once wages or wage growth is at 3%, right? So the first, or in this chart at least, the first interest rate rise cycle was in 1999 and wage growth was already at 3%. 2002, it was already at 3%. In 2009, it was already at 3%. This time, it's just a smidgen over 2% interest rates are already on the rise. So this is a very important measure that I personally think, and based on all of my analysis, and it seems like CBA agrees, it will limit the amount of interest rate rises that the RBA can do because it cares about wage growth. The media doesn't really talk about this stuff, right? But these are the truths. Okay. I'm just going to stop there, guys. This was part 2 of a 3-part series on how to understand this rising interest rate cycle, the impact on the Australian economy, and therefore how much impact it will have on house prices and just how much interest rates will actually last. Okay, I'm going to do part 3 next video. If you haven't watched part 1, go back to that. But guys, I really want you to get so much out of this because it's going really deep. This is deep stuff. It's not for just everyone. It's only for those who, let me be a bit clickbaity and say, genuinely want to become multi-millionaires. Hit the subscribe button, turn notification bell on, all that sort of thing. Hit the subscribe. My name's PK. Thank you so much. I'll see you in the next video in, let's say, 2 or 3 days' time. Catch you later.